Hey, welcome to Advisors Lodge, a podcast for all financial advisors. I'm one of your hosts, Edward Pai.
And I'm your other host, Roger Ling. Join us as we chat with industry experts to get the best advisor tips and ideas.
Welcome, everyone. In today's episode of Advisors Lodge, we look at where interest rates are headed in the US and in the Asia, and how advisors can answer their questions about getting higher yields and higher returns in the current environment. So it's a very interesting topic that is actually relatable to what's happening in today's market, and sharing this insight with us today, we actually have Wayne Lau from our multi-asset team at UOB AM. So, before I actually start the podcast proper, let us all, tune in to what Wayne basically does at UOB AM. So, Wayne, would you like to share? I think our audience would love to know what you do because it's really interesting.
Yep. Hey, thanks, Edward. Thanks, Roger. I think first of all, thanks for having me here. I'm quite happy to be sharing with you more about UOB Asset Management, in particular the multi-asset team, which I'm part of. So I think when it comes to sort of the work at UOB AM, the main thing is really about trying to do more research. So I sort of split my work into three parts. I think the first is doing research on more economic stuff, research strategic stuff. And that means really forming our macro views on issues like growth, on issues like inflation. I think these two have been key issues surrounding the world over the past few years, as well as, and not just that, but also our sort of corresponding views on markets, meaning how markets would react to this kind of macro trends. So that's the first thing. I think the second part is more on a longer term basis. It's really supporting our multi-asset team in coming up with optimal solutions for our clients. I think they tend to be more institutional in nature, and we do have inputs such as our long-term capital market assumptions which feed into this type of solutions that we create for clients. And I do support quite a bit on that front as well. And I think the third is really in assisting the PMs to the portfolio managers in managing some of their portfolios. And that also mean finding the sort of best solutions we have to implement our existing house views on asset allocation topics, but also sort of customize to each client preferences, such as their risk tolerance.
Hey Wayne, thanks so much for the brief intro. I think the listeners will be actually very keen as well, understanding that you actually look at some of the more technical teams, technical stuff within the UOB Asset Management team as well. As what Edward has pointed out, we know that the rates are getting a little bit more interesting and dicey. So, do you happen to know that the FD rates, especially across the banks, I think they have been reduced over the last past 6 months. We know the rates will be very high, but right now seems like the rates have been reduced over the last 6 months. And if that's the case, right? So as you are analyzing some of the macroeconomic conditions, does it have anything to do with what is happening in the US and Asia, especially when it comes to the rates part? Any thoughts on that?
Yeah, thanks, Roger. I think you brought up an interesting point. On the whole, I think reduction in fixed D rates, that's something my uncle and aunties tend to ask me about also. So that's I mean, I try my best to answer them, and I will try to my best to answer you here. But I think first off, I think more on interest rates in Singapore. Singapore is sort of an open capital market economy, as I'm sure you guys know. I think the MAS does not set its own interest rates, and hence the way interest rates are sort of dictated are based on global interest rate trends. So Singapore interest rates tend to follow global interest rates. I think what has happened over the past few months is we have seen more and more expectations of rate cuts in the US and also in other parts of the world. And as you have interest rates that are projected to fall in terms of its trajectory, um, you can expect the banks, our local banks, to actually cut fixed D rates, especially if they have a view that interest rates are going to fall. I think we can also sort of see that in the recent TBO auctions where where the yields have also been lower as well.
So I think that's a very good way to actually put it, right? And how you mentioned in the long run, where do you see the rates going, right? As in the US and
Mm.
Singapore as well as also Asia. I think we also want to know, yeah, this year what is going to actually happen because on the market. Fed chair is saying that there's going to be one cut, but what about next year? What about 2 years later? Right, I think audience will also be interested to basically know so that they can position their portfolios. Yep.
Yeah, I think we and probably the market has spent a lot of time on this topic, and I think just to sort of lay out some of our views here, I think for this year in the US, we continue to expect 1 to 2 rate cuts. I think that has sort of been our long-standing view. And that's really just based on our macro view that for the rest of the year, we see growth sort of moderating a bit, consumer spending less, and inflation to also continue to moderate from here. That's and that's for the US. And I think for next year as well, we probably get a few rate cuts, and that's also based on the continuation of this kind of moderating growth and inflation type trends. Um, and while that's for the US, I think if we look across Asia, Asia is a lot more complicated. The Asia story is not so uniform, and but basically to sort of back it up a bit, Asian or the central banks in Asia generally have not hiked interest rates as much as they have done, as much as the Fed has done over the past 2 years. Hence, if you consider two things, the first is that Asia central banks have actually hiked earlier. They have not hiked interest rates as much. Actually, their potential to cut rates from here on is likely lower compared to that of the Fed. So that's in general, but I think the more nuanced picture is really that we can split Asian central banks into three broad buckets. I think the first bucket is that we have countries like Japan where they are needing to hike. I think that's in contrast to the rest of the world where most of the world is looking to cut. We have China. I think the economy is where the economy is really depending more on monetary stimulus to solve some of its structural issues, like its property sector, the decline of the property prices in China. And I think the third is, I think countries like Korea, Taiwan, even Singapore, where we are sort of waiting for the US to ease before we can start to ease more, so as to ensure that our currency fluctuations are not that great compared to that of major countries like the US.
I see. So, I mean, thanks for sharing. I think that's quite comprehensive in terms of the coverage. Closer to home, and I think you brought up the point earlier that say that, for Singapore context, we don't look at the interest rates as a measuring tool, as a lever to turn on and turn off the tap, to ensure that the flow is just nice. We use a basket of currency, so on and so forth. But end of the day, what we are keen here in Singapore, especially those, to closer to home, is really about the prices. In terms of inflation, we are seeing that. We can feel it. I think the recent report came out from yesterday. They mentioned about the rates, the CPI numbers for Singapore is still high, probably on a year-on-year basis, is about 3.1 to 3 point or thereabouts. And I think the guidance of it is about 2.5 to about 3-ish, thereabouts. So, I mean, we all know, right, how expensive things are getting in terms of inflation, right? And I think that's something that will hit us hard. Do you think the prices will still be as high given whatever that the guidance have come out from MTI, Ministry of Trade and Industry, and how this is going to pan out to be as well?
I think on that, okay, I think it's an important point that you're mentioning here. So I always hear inflation and high prices being mentioned in the same breath. I think it's important to make the distinction between both of them. But before I sort of touch on them, maybe let me just turn it back to you guys, both you, Roger, as well, Edward, and just to see, how in touch are you guys with economic realities in Singapore? So I'm just going to give you a few categories, and can you guess which of these item has seen the biggest price increase since the pandemic hit in Singapore? So so these like a multiple choice question type thing, and
All the
the
above.
no, which one is the highest? Which one is the highest? Okay,
COE,
so the
COE.
first one. Okay, no, make a guess, make a guess, make a guess. So the first one, food prices. Second one, car prices, your COE. The third one, housing prices, and the fourth one, electricity prices. Can you guess which has the highest price increase?
Whoa, actually also increase. I want to buy car also have to think twice. Electricity I'm paying more. Okay, maybe I think my pick. I'll choose electricity.
Yeah,
How
I
about
actually I
Roger?
wanted to go the same as Edward as well. I think electricity prices have been going up. Yeah.
If I'm
Okay.
wrong, about 20-30%. I'm
It's actually a good guess. Lah. Electricity is the second highest, but car prices is the highest increase. So just to give you some stats that I sort of Googled a couple of weeks back, car prices have increased close to 60% since COVID, and electricity prices have increased 25%.
right. Whoa.
So the piece of metal is getting more and more expensive. Let's go
Yeah,
green.
it's
Let's
also a
go
personal
green.
gripe of mine because I wanted to buy a car before the pandemic, but looks like I don't have much hope in that area.
You can buy my car. I'm putting up for sale. I'll give you a friendship price for that. Yeah.
Okay, so anyway, just related to question. If you now you know that car prices have increased by 58% since the pandemic, can you now guess what's the year-on-year change in car prices?
Wow,
Just a random
year-on-year.
number, just a random, just a.
Oh, I don't know, maybe 12, 15% on year-on-year.
88%.
So the year-on-year change in car prices, which I was also surprised to see, has actually just been up by 2%. And and and,
Oh,
and yeah.
2%. Wow. Okay, that's something that I never expect. Okay.
And here's the sort of point that I think it's important to make. So inflation and high prices, they are talking about the same thing. They're generally talking about prices, but inflation is really more about measuring the change in prices, whereas high prices, you're talking about it from a level perspective. So while you had car prices that increased from 58%, increased by 58% since the pandemic, I think what your central banks, what MAS would tend to be looking at would be the things like the year-on-year change in car prices as well, which in this case is 2%. And this sort of distinction is important, really, because I think, as a practical investor, we look at the big players in the world, your Fed, your central banks that are around the world, when it comes to managing monetary policies, they tend to be looking at things like your inflation rather than your level of prices, which I think have been high and is unlikely to go down materially so much. However, for inflation itself, which is more of a year-on-year or a change concept, that is likely to moderate for the rest of the year. And herein, our view on inflation is really pretty simple. I think if we look at the U.S. economy itself, we have done a deep dive on the drivers of inflation. We can see that what's holding up inflation is really things like your rental prices, your auto insurance prices, where if you look at the drivers of both of these components, it's likely that those two prices will sort of moderate over the next 6 to 12 months. I think we can already see that in your new rental leases, which has been lower than historical. And we can also see that in the new rate filings of car insurance companies, which have been coming down in terms of the rates that they're issuing to consumers. Hence, I think with that in mind, we do think that inflation would continue to moderate for the rest of the year. And given that Singapore inflation is also generally quite linked to the global inflation, that should also sort of come down and to be quite in line with, I think, what MTI has talked about, sort of in that 2.5% to 3% type range.
Yeah, so I think maybe in a nutshell, what that mean basically also mean that we are in a higher for longer regime. I think we have UOBM has always been highlighting this.
Mm.
So and of course in the light of this, my next question is basically what can individuals do to get higher use. Okay, why I am actually asking this is we actually did basically own industry research, and we feel that when we look at where monies are flowing in Singapore, basically 50% of the flows are going into one asset class only, which is like your money market and your cash and your fixed
Mm.
deposit, and the rest of the 50 is actually separate across different asset classes like global equities, US tech, Asia equity, and then it's all basically spread around all these, and is actually quite surprising to see that one asset class basically take up 50% of it, and based on what you're saying to moderate and so on and so forth, the T-bills rates probably will come down. You are already seeing FD rates coming down and so on, right? So with that in mind, where how yourself personally, how do you get higher yields, or what do you what advice do you have for our audience out there? Yeah.
Yeah, I think it's interesting. I didn't know that most of the flows today are going to money market. But this also means that 50% of this money is sort of like leaving some of the returns on the table. Because if you look at the other asset classes, I think equities have done really well over the past year or two. And that does suggest that um, there are still more gains to get. Anyway, I think on this topic, just on our outlook on this is really that we still have a relatively benign sort of macro view that we think should allow for continued normal investments. I think we think that growth should continue to remain sort of resilient from here, even though it could moderate a touch. Inflation should sort of improve, as I shared earlier. And this is sort of the type of environment where we think that if you want higher use, you can do things that give you a pickup in use. And those are that can be things like taking on more credit risks. I think especially that can be done especially for issues that credit issues that are close to maturity to sort of minimize the spread duration risk here, while at the same time getting that you pick up. And I think for investors with also longer time horizon where you are less concerned with the what you can get over the next 6 months, those investors can also start to think of going longer duration, buying into the longer maturity type bonds. And this is because I only say that because we are sort of closer to the end of cycle. Even though we have a sanguine view on growth, growth risk is sort of balanced here, and there are still downside risks to growth. And as the Fed cuts rates, the shorter end should be less and less attractive. Cash should become less attractive, and hence that would be when if you go longer duration, you should benefit in the if you have a longer time or investment time horizon here.
Yeah, thanks, Wayne. I think probably just to for the sake of some of the listeners in for this episode itself is that I think what Wayne is trying to suggest is that I think there are gains still be able to be achieved in the equity market. And I think just to put it a little bit more easy to understand, especially on the spread compression and going on the shorter end of the curve and all that. So basically, what we're trying to say here is more on the shorter duration. I think that's something that we want to highlight. Going up the credit risk, like what Wade has suggested, which is to say that moving out from cash where you comes in, and that's where you step up to a higher yielding, shorter duration of what we call a bond, even let's say a corporate bond itself, which some of our funds are already invested in it as well. So that is probably some of the areas that clients could be looking at gaining a higher use, because we know that, like what I always mentioned, in a higher for longer, or right now I think for UB we are saying it's a stronger for longer kind of a regime. So if we want to overcome the inflation, like what Wayne has mentioned, we will overcome the higher interest rates right now. There are things there, and if we want to move off from cash, then the shorter duration credits or corporate bonds is something that probably we need to look at, and probably something to consider as well. But so probably just to lead on to that is that if really from your probably your family members will come to you soon,
Mhm.
and asking you, as an individual, how do I want to achieve returns that are higher than the current inflation? We all know that right now inflation is two-ish, or 3+% right now. What can we do to achieve returns that are supposed to be higher than inflation? Any thoughts on that?
Okay, so I think to sort of get returns that are higher than inflation, we have sort of done like a longer term type research on this. And generally, if you are invested in cash, your return should roughly equal that of inflation over the long horizon, plus maybe one maximum two type percent type level. I think in the longer time horizon, I think it's best to make your money work for you. Staying invested, being in equities, being in longer duration bonds, being in credits, those would help you to get returns that are above cash. And that I think is a sound investment advice that we tend to give our institutional clients with longer mandates as well. However, I think if we are also just looking at the next 6 to 12 months type picture, like I said, macro view is still pretty positive. Equity markets can continue to deliver good returns, and hence, we think that message still holds in even in the next 6 to 12 months, and that's ready to continue to sort of stay invested in this market.
All right. Okay. That's actually a quite a good answer. So and okay, we're coming to the last part, right? So one part is when we talk about investments, what we have been hearing on the ground is, should we always invest in US dollars or in local currency? One thing that there's a popularity in gaining of the US dollar investments are basically, if you look at your T bills, right? They're relatively high, and basically clients are actually going to it. And of course, if you look at the US tech sector, US S&P 500 is actually also on the gain. So US dollar investment has been really, really gaining popularity among the local investors as well. And of course, we still have our own local currency. So because you deal with multi-asset strategies, basically, as a professional point of view, should individuals today choose to invest in US dollar or in local currency, also taking into consideration the mentioning of the interest rate you've actually talked about in different geographical areas as well. Yeah, maybe just want to pick your thoughts on that. Hmm.
Okay. So I think from an interest rate perspective, being staying in USD has been great for the past 2 years. Exchange rate has also favored USD a lot. I mean, now you can easily get 5% in USD versus I think in Singapore max you get 3.5%. Hence that has sort of always been the reasons why we should invest in US currencies. Our sort of view on this is that why the US dollar has been strong for the past 2 years, it's really down to two factors. I think the first is that US has been exceptional in terms of its growth resilience relative to the rest of the world. I think post-COVID, while we are expecting recession everywhere, I think the US actually had since saw like strong recovery in growth, and hence that has supported the USD a lot. And the second is that I think sort of mentioned earlier, US has also hiked rates quite a bit more compared to that of the other major economies, and this has in turn allowed the U differentials across U differentials of the US compared to that of other countries to be more favorable for that of US dollars. However, I think within these two factors, I think at the margin, both factors are starting to turn a little. Uh, the Fed could cut rates probably in September, probably in November or December. That part is unclear. But I think once, if you sort of take a slightly 6 to 12 month type horizon, I think once rates are cut, US dollar could sort of become weaker. And this is also in line with sort of the historical rate cut episodes that we've seen over the past few decades. So I guess the bottom line here is this growth momentum has also sort of been which has been sort of more favorable for the US economy, is also starting to turn a little. We start to see Asia growth being a bit stronger now. We've seen manufacturing PMIs in Asia becoming stronger. Interest rate differential could also become a bit more, could also at the margin become slightly less unfavorable for the US. And hence, I think all things considered, we think that the US dollar could sort of weaken a bit from here, and hence it might be worthwhile just holding on to some exposure of local currencies or tilting that balance a bit more to your local currencies instead.
Hey, thanks, Wayne. I think that's a very good summary and all. And I think what we want our audience to really think back is that it is not scary to to go into the investing world right now. Seems like the growth picture in Asia is still looking attractive. There are asset classes for individuals to get higher yields and to really overcome the inflation that we are going into in the next decade or so. And I think there are more than just cash right now that like you pointed out, they are still doing well, and the numbers back for itself. So all in all, I think we are into a relatively more comfortable environment right now, and I think people tend to overlook that. No doubt, the cash and the T bills and all that still look attractive. I think that's without a doubt. But in order to encourage our clients to be a little bit more take on a little bit of the risk, but then again, your downside is kind of protected from various to a certain extent. I think that's the key point that we want to put it as a concluding statement, for today's episode and all. So all in all, I would like to say thank you, Wayne, for coming on board today, and we really hope that the audience here, has gained certain insights, and it will be beneficial to you as well. And as you speak to your clients as well, for the advisors, this will be something that will be great as a talking point too. Thanks, Wayne. And yeah, do let me know if you still want to view my car. It's open for viewing anytime.
Yeah, my car
Thank-
as well.
Is it 58% higher than what you charged me a few years ago?
the COE will be higher. Okay.
Thanks, Roger. Thanks, Edward, for having me here today.
Yep. Thank you, Wade.
Thanks, Wayne. Cheers.
Cheers. And to all
Bye.
our audience out there, please follow us on our podcast and leave any feedback if you have one. Thank you.
Thanks everyone for listening to this episode of Advisors Lodge.
Have any questions or feedback for us? Drop us a comment below. We love to hear from you.